Bailey is at the Small Business Administration. She's the Associate Director or Associate Administrator, and also is the head of the Office of Innovation and Investment. And we can unpack more about what that means, but by and large, it means that Bailey helps lead the deployment of billions of dollars throughout the U.S. innovation ecosystem. Again, something we'll talk more about. Some programs are the SBIC, Small Business Investment Corporation, Small Business Innovation Research, Small Business Technology Transfer, the Growth Accelerator Fund Competition, Federal and State Technology Partnership Program, and Bailey also comes from a really interesting background in the capital markets, which we can talk about, especially most recently at T. Rowe Price. And Bailey, you can also help me with some of those acronyms that I got wrong along the way. Bailey and I had the chance to work together in government, and she is one of the best public servants that I met, and one of the most forward-leaning, and one of the people who's made the most impact in the last several years. It was a real honor to serve with Bailey, and a real honor to have her here on campus. So let's give her a round of applause to welcome her here. So Bailey, let's actually start with your journey into government.
It definitely is not linear, although it's been an absolute privilege to be in government. I have to say, I wake up excited every day, even though I'm frustrated some days, but would like things to move faster. It's an absolute privilege, and I do recommend to anyone, if you ever think about giving back and serving either in a federal position or state or even in your local government, it's amazing what you can do, and we need talented, mission-driven individuals serving our country in all capacities. But it definitely was not linear. I came out of college and ended up in management and strategy consulting, and then when they asked me which practice area I wanted to be in, I said financial services because that is the business that my father had been in and my grandfather. They had been at the Chicago Mercantile Exchange and Board of Trade, and then my father had basically, I guess you'd call it a fintech in the 70s and 80s a few times over. And so it's like, okay, no financial services. And it turned out that we were launching a research practice for buy-side asset management firms to help them not with running money, but with the strategy and people management, organizational management, and product and distribution. And it was a tremendously successful launch of that research practice. I took on a promotion then to manage our relationships with 40 CEOs of global buy-side asset management firms. So I had this incredible window that I lucked into of getting to sit down and hear all about these firms from their CEOs and to go travel and meet with them. So it was very much luck. And so lucky that I didn't realize how lucky I was that I decided to leave and go to grad school, went over to Northwestern, pursued a master's in marketing with a focus on data-driven marketing and statistics, went to go work at 3M. I thought I was going to work at 3M in strategy for years. And then the global financial crisis struck, and they rescinded all their MBA and master's offers. So I went back to DC, went back to my old firm, and then I was like, gosh, people are going to cut consulting right now. This is probably not going to be good. And started networking and ended up taking a role at a holding company that was buying up defense and intel contractors with the plan to take it public. And I was like, oh, this sounds like fun. Go join, be able to be involved in an IPO roadshow, start to learn about corporate development, government contracting, and that was an incredible experience. Our first acquisition was John Brennan's firm, the Analysis Corporation, and then we started to acquire some businesses that were doing work with NSA. But I had the opportunity then to experience what it was like to be working at a company that had gone public, and then we were taken private in a leveraged buyout by Ares. And that was a very operational experience of feeling what that is like, very different than a growth equity or a venture investment. And so, life then with my husband ended up taking me to Baltimore. And I said, there's one firm I'd love to go work for because the CEO I thought was just a phenomenal human being, Bill Stromberg at the time, and ended up going to work at T. Rowe Price and actually worked in strategy, helping build out their data-driven distribution, but then was recruited over to do institutional capital formation with large sovereign wealths, so defined benefit and defined contribution plans, endowments, foundations, and starting to structure more separately managed accounts. And I thought I'd be there for life. And then I was recruited over to this firm, Greenspring Associates, now Stepstone. The founder had been in my group at T. Rowe, and he said, due diligencing fund managers, it's the same thing as, raising large-scale capital. It's just two sides of the coin. You could be a fund investor, and you know more about venture than you think you do. We had a lot of relationships outside of work in that area, and my husband was in venture capital, early-stage venture capital. And so I decided to take the leap. Why not? Trust your gut. And I went over there, was having a wonderful experience, launched their first evergreen vehicle, their first emerging manager fund. And then the pandemic struck. And people maybe don't remember this, but because it seems like, then venture valuations got really high, everything was up to the right. But for a little while, we thought, oh my gosh, venture is in the toilet. We're all going to be looking for jobs. It was a very scary moment for a little bit. And we were turning our attention to focus on China, and some other priorities were shifting. And I had kind of a principles and values moment. And by the way, it's a phenomenal firm, and they do really great things, and just great leader over there. But I started to have some conversations with mentors from different parts of my life. And it just so happened that they were starting to get involved in the transition for the Biden campaign, and I started to get an itch. And it's funny what happens when you get an itch. If you get an itch to do something, have you ever had that feeling? It doesn't go away, even though you try to quiet it. And then I was fortunate that my husband said, yes, you can take a big salary cut, and I'll support you, and you want to do this. And then I lucked into getting this amazing letter asking if I would be willing to serve leading the Office of Investment and Innovation, which, to be honest, Eric, has felt like the biggest gift because it integrates so many different parts of my very nonlinear career. So I think there's always luck. Anyone who says that they don't have, luck in their career experience is lying to you. There's always luck, and then follow your heart. So.
Well, let's talk about your role and how those pieces came together.
Yes.
So tell us about what's within your office and your mandate.
I'm biased. I think we have the coolest office at the U.S. Small Business Administration.
I agree.
For those that are not familiar with the SBA, it was established during the Eisenhower administration, really with the premise of public-private partnership at the heart of everything the agency does, in recognition of the importance of small businesses in terms of job creation and economic growth within the country. And the SBA, believe it or not, also does everyone know that the SBA provides more disaster funding than FEMA? It's an interesting time right now with what we're going through. The SBA is really critical with disaster loans. And the SBA, I'd say, has been more on everyone's radar with COVID because of the Paycheck Protection Program, so a disaster relief lending program. But in addition to the loan programs, our office is it's tough, right? The SBA, small businesses. Our office is really about that innovation economy, those startup businesses, the businesses that are scaling. And so our portfolio focuses there. And one of the gems, there's a couple gems in the office, but one of the gems of the program that we have is the Small Business Investment Company program, the SBIC program. You might say, what in the world is that? Well, it's a $46 billion pool of assets today with over 320 private funds that we manage. So in many respects, I'd think of us very akin to a large institutional investor that's investing in funds. However, we're not a limited partner. We do not put equity into the fund. Instead, what we do is we loan money to the fund as a match against the private capital. And as a result of that, we're kind of like a low returning investor in many ways. So that way more money can go to the limited partners and the general partners. And an interesting thing that happens, we were talking about it earlier, when you put leverage on a basket, a diversified basket of investments, it can actually serve to de-risk it while enhancing the returns. So it produces more competitive returns. And the idea behind the program when it was established was that there was not enough private capital flowing to small businesses to help them start and to help them scale, and that we needed another way to incentivize private capital to come into these areas because it was so vital to the economy. And so I'll really stress the point that it was not the government replacing our private capital markets, but it said, there is a gap, and if we add another factor to the return equation, if we essentially had a lower returning investor, that would make those investments more attractive for the private sector to put money in. Because at the end of the day, right, any private investor is saying, it's a relative value play about where you're going to put your money. You're always making a decision around, do I put it in public equities? Do I put it in venture? Do I put it in growth? You're always making a decision about return and risk. And so if we could come up with a diversified structure that lowers the volatility and potentially increases the return, that's more attractive. And so that's a little bit about the program. I'll talk more about it as we go. It has given rise to amazing companies. It financed Apple, Amgen, Whole Foods, Cray Computing. I mean, the list goes on. Many of the funds in the program back in the day were some of the original venture capital funds that financed the semiconductor industry. Intel was one of their investments. So the program, probably never heard of it. It has played a vital role in Silicon Valley and many communities across the country. But in addition to that, we have an incredible portfolio called the Small Business Innovation Research and Tech Transfer Program. So SBIR, STTR, you may have heard of that, maybe not. But this program, really cool, created, we're celebrating, I think, the 40th anniversary of the program recently. The idea that any federal agency that had a very large R&D budget, that they should set aside money specifically for contracts or grants to help with R&D, prototyping, and starting innovative companies and helping them commercialize. It is just an amazing program. We put out $4 billion a year through this program. And so actually for any current entrepreneurs or aspiring entrepreneurs in the room, this is a phenomenal program. And actually, Stanford is one of the leading universities in terms of tech transfer out of the SBIR program, or the STTR program. Because with the tech transfer program, you have a university coming in and essentially sponsoring, co-owning some of the company with an entrepreneur to drive those ideas forward. So very awesome program we can provide more information on. And then some of the other ecosystem programs you talked about, I'll just touch on the Federal and State Technology Partnership Program, FAST program. The government provides money every single year to help people navigate how to apply for the SBIR and STTR program, which I think is a wonderful thing because federal programs are not always the easiest thing to navigate.
As we think about those numbers, it's absolutely astounding to think of $4 billion per year in SBIR funds. When a lot of funds talk about how much they have assets under management, that's over a period of time and cumulative. This is every single year. $4
billion every year. We've been $4 billion for now the last 4 years, slightly, but the growth has been steady. So as you think about it, for better or worse, as the federal government budget swells at these large agencies, that means that more money is put aside for SBIR and STTR contracts and grants.
So if you've heard of organizations like AFWorks or the Army Applications Lab or Naval X or many others, the primary tool that they're often using is SBIR and STTR.
SBIR and STTR.
So linking that with maybe some more familiar concepts, this is the office that Bailey leads. Now here we are, we're in a class called Silicon Valley and the U.S. government. There are some who say the private sector doesn't need government assistance. There are others who advocate for that. It's a kind of an ongoing tension, and yet this program has persisted, as you mentioned, for over 40 years.
Yes.
Can you tell us about the role of this program and how it affects our prosperity?
So, I'm of the mind that you often you get what you incentivize, and that the government can play a role in helping to incentivize investments in certain areas. And I'll give the example, and by the way, nothing against software. I make the joke at home all the time, or my husband makes it. He goes, "Are you trying to put me out of business?" He's a B2B software investor. I'm like, no, there's plenty of private sector money that goes there. It's that we can't just focus there. We have to think about our economic security, our national security, and we have to think about how do we make it attractive to invest in things that are really long duration in nature or really, really capital intensive upfront? Like, how do we make it attractive, to create factories, to invest in big, 3D printing machines, hypersonics, biotech, things where there's potentially binary outcomes. So I'd offer up that is the opportunity for the federal government to come in and de-risk investment or be able to stimulate investment in certain areas by improving the risk-adjusted returns. And SBICs are one way to do it, but the SBIR and STTR programs de-risk as well by providing non-dilutive funding to get early money into these ideas so you can do the R&D that you need to do, so you can prototype, so you can commercialize, and then be able to attract more private capital that wouldn't come in as early. So SBIR is what I would consider that earliest of early money to come in to help get the business started. And the money that comes from SBIR, all of that has to specifically go into the R&D and the prototyping and development work.
Now, there are those who call this America's Seed Fund.
Yes.
Can you tell us more about what that means and how we could think about that more accurately? And
It was a big branding exercise during the Obama administration where they said, okay, well, rather than call it SBIR, let's try to think about how do we capture hearts and minds and make it clear to entrepreneurs that we're seeding ideas here, and to start to increase awareness of the program more broadly, rather than thinking about it as a contracting or grant mechanism at different agencies, to make it clear that there is a large available pot of money, and it is here to seed those early ideas. I think it's been an excellent thing. It's caught fire, and I think it is a really elegant way to describe the purpose of the program around seeding those early ideas.
now, this is the Small Business Administration.
Yes.
And that definition of small business is brought up a lot about who's included, who's not, especially as in Silicon Valley, we are in a world of startups.
Yes.
Talk us through some of those definitions and maybe some of the ways that...
I'm going to share a lot of my personal opinions now. So just as a disclaimer, these are not, opinions of the Biden-Harris administration. Innovation economy, startups, and small businesses have tremendous differences from, say, your Main Street businesses or very, asset-light services businesses. They are, the commonality might be that they're all small from a size standard perspective. I can talk a little bit about that. But they have unique challenges and different needs. So the SBA sets what they call size standards for all small business government contracting, all small business programs, small business lending across the entire federal government. And so I share this to say, if you ever hear somebody say, the DoD makes it impossible for me to win a contract, I have to go up against General Dynamics or Lockheed Martin. It's actually not the Department of Defense that's making that really hard for you. The Department of Defense has, they have regulations that they have to follow that are set by the SBA. And by the way, these are regulations, they're not statute. This is an important thing. So there's no legislation that actually says it has to be this way, and this is how we define it. So it is up to the agency. And this is actually a very interesting time. I won't get into it too much, but there was a recent Supreme Court ruling, the Chevron decision, that reverts back some of the thinking and approach around the discretion and authorities interpretations of federal agencies in terms of their statutory authorities. So I think it's an interesting time here because our regulations in terms of what constitutes a small business, they've been in place for a very, very long time. Okay, and so why does this matter? So size, it could be the number of employees, it could be the revenues of the business. In financial services, it could be the assets of the business. But there's other elements of size, control and affiliation. What in the world do I mean by control and affiliation? So we'll take control first. So positive and negative controls of a business. So you could look at control based on your ownership, so the percent of ownership that you have in a business. And the negative controls could be triggered by things like voting rights of board members. Okay, that's important. And then affiliation, what's affiliation? So you can be affiliated with other entities, other businesses, based on the level of ownership that they have over you. Why does this matter? Well, it matters a great deal within the innovation economy because many times you need to get outside capital. You're not necessarily always bootstrapping your business. And I'd also offer up that having people on your board can be a good thing for governance, also helps with networks. Okay, so what's the situation today? Well, right now it's fairly restrictive. It has been again, my personal opinion, I've had a very paternalistic view of that those regulations take a very paternalistic view that also favors founder owned and operated and led businesses, right? So individuals that have bootstrapped their business. If they've bootstrapped their business and they meet the size standards and they haven't given up control, they haven't given up a lot of ownership, guess what? They often qualify under different small business set-aside programs in the federal government to give them a fast path to government contracting or to be able to get directed contracts where they don't even have to compete. Isn't that amazing? It's incredible. But guess what? You typically don't qualify if you have outside, say, venture capital investment or growth equity investment because you trigger these affiliation and control rules. This is really problematic. Why is it problematic? Because the commonality that we have often with innovative startups is the fact that they do have the outside investment, and that is a good thing. And they have the outside board members, and so they are not eligible for small business set-aside contracts, and so they have to compete with really large businesses like General Dynamics and Lockheed Martin, great companies that do a lot of good for our national security, but they don't have the same resources. And so it's often a waste for them to go head-to-head with them. So what do? They end up subcontracting to them. So then they don't have a relationship with the customer directly, and they give up a lot of their margins, and then ultimately often get acquired rather than continuing to grow as independent companies, which can stifle innovation in many situations. It also hurts our tax base, right? Because we polarize the economy with really small and really large. So during the pandemic, an interesting thing happened. Some folks might remember this, that all of a sudden, most of these venture-backed businesses, they couldn't get a PPP loan. Oh my gosh, they could not get a PPP loan. So we were about to lose all of these amazing businesses with great IP, doing innovative things because of these affiliation and control rules, because SBA lending follows these rules as well. The NVCA was very vocal about this, and the agency moved and waived the affiliation and control rules to get loans out. Then during this administration, had a nice opportunity actually to be in charge of our loan programs and our investment programs for a period of time. And we pushed forward changes in our regulations for lending, where now the affiliation and control rules do not apply in all of our lending programs, which is amazing because now, and particularly following SVB weekend and less venture debt, more venture-backed businesses can get access to low-cost government loans for working capital and also asset-based lending programs. But we haven't addressed the contracting problem, and it is a large problem, I would say, and there are potential solutions to fix it. And I'd say it is vital when it comes to innovative startups, particularly those that are very capital intensive. And the last point I'll share, sorry, I could go on this about a long time, is that the interesting thing about the nature of these regulations and the paternalism is that we have had these programs that are focused on helping have government contracting pathways for socially and economically disadvantaged businesses. But the irony is, I go back to my earlier point, that those pathways exist for individuals that have enough money to bootstrap and self-fund their businesses. So isn't that a little bit backwards? Because it typically isn't the person that has enough money to bootstrap their business that is going and getting venture funding, right? They're often going to get outside funding because they don't have the money. And we have set conditions such that the very entrepreneurs that need the money the most cannot take that money and pursue government contracts as a small business. So I'd say it seems a little backwards today.
So Bailey, let's talk about one more topic before we go over to Q&A. You've been leading this small business investment company program. You mentioned the size of it, over $46 billion.
$46 billion now, I know, it's exciting.
In funding out there right now. It's a program that's been around since 1958. And under your leadership, and it's been really amazing to see what you've been able to do to work more with the venture community. You introduced a new tool a new financial instrument called the Accrual of the Venture. And you've also worked on a partnership with the Department of Defense and the Office of Strategic Capital. Can you tell us a little more about that program and give us an update on how it's going?
Yeah. So I'll start with when I had the fortunate opportunity to move into this position, one of the first things that I did was sit down with my team. Many folks on the team had been there for 20 some odd years, and I said, what's on your wish list of things that we accomplish over the next couple of years? And also, what are our principles and values? I've enjoyed talking with you about your work. But it's, what are our principles and values, and also how do those tie to the mission and intent of Congress with the programs that we are responsible for administering? Because at the end of the day, we're here to serve, and our job is to deliver on that mission and intent. And the mission and intent of Congress with the SBIC program was to stimulate and supplement the flow of equity capital with the ability to provide private debt and long-term loans to small businesses and startups to enhance job creation and economic growth. And then it goes on to talk about, a focus on, things that are manufactured and produced domestically as well. So I take that a lot of supply chain that goes on later about national security. And we all agreed that we'd give ourselves a low mark in terms of how we're doing on meeting the mission and intent of Congress, because the program for the last 20 years had been providing funding to a lot of mezzanine debt funds and direct lending funds and structured equity and some buyout. But we asked ourselves why, right? We said, why is this happening? And it was happening because, one, we had poor product market fit with our loan instrument. Think of it like an agency-backed security. Poor product market fit for anything that was doing equity investing and long-term loans. That was one. And then the regulations were all written around that instrument and around the types of teams that were providing mezzanine debt funding. And regulations have been written over time that just people add to regulation often. They don't maybe look at it and design thinking, say, like what to take away. And so we sat down as a team and we started to pick it apart and said, like, let's try to agree on individual points. And what needs to change in regulation? What do we need to change procedurally? And came together and agreed on a set of things that we'd like to see evolve. And then asked different individuals across the team to write, say, you rewrite it, you change parts of the regulation, and let's come together and review it collectively as a team. And so one of the things I'm thrilled about is that we took a team approach, had very much aligned on what our mission was and the principles and what our goals and objectives were. And with that, we were able to advance the creation of a new government guaranteed loan designed to have good product market fit with early stage VC funds, growth equity funds, fund of funds, what I call buy and build strategies, or it might be control equity. And the demand and interest has been phenomenal. We had 127 applications for our program this year. Typically, we had about 33 in a given year, so it's just been absolutely tremendous growth. And it is phenomenal to see, just the enthusiasm and also the bipartisan support for the program at this point in time. And then the other part is a little bit of luck that Jason Rothji, who's the director of OSC, was doing some consulting for the National Economic Council and the National Security Council at the time that I was on a White House Interagency Policy Committee on Scale-Up Manufacturing. And I really felt it was important to get buy-in on this new instrument and regulatory changes from the White House and a broader base of agencies before bringing it forward. And Jason said, oh my gosh, if you do this, could we talk about a partnership? Because this instrument, he had conviction, would help start to show a pathway of how we could solve for some of the challenges around investment in technologies critical to national security. And again, luck and also personalities. Jason's a no-ego person. We had all of our teams involved. We gained a lot of momentum for bringing this forward. And the White House liked the idea that the Defense Department was pairing up with an agency that had been doing this for a long time. And that gave birth to the Office of Strategic Capital on our very first program, which we call the SBIC Critical Technologies Initiative, where now the federal government is providing government guaranteed loans to funds that are investing in critical tech areas at the early stage, at scale up, but also on the debt side as well. So we're trying to address the entire capital stack. I am very pleased to say that next week we'll be making some big announcements about a very good diversified group of funds that'll be the first to invest in this area, and a strong base of limited partners that are investing in them because they've done the math and they see this is a good thing for the private sector too.
And Bailey, one more thing before we go to Q&A. If you could unpack just a little bit about what this new Critical Technologies Initiative can unlock in terms of the technology areas that you can address.
Yes, so there's 14 critical technology areas. I recommend going to the DoD Research and Engineering website to look at all the critical tech, but I'll give you an idea of some of the areas that these funds are focused on. And by the way, the funds are not focused on one area, and this is an important thing, right? So it was important that these funds have large TAMs, total addressable markets, and that they be able to diversify across technologies, in industries to make sure that they're in a position to diversify away risk while having the opportunity for outperformance. But it's things like hypersonics and trusted AI and biotech and renewable energy, cybersecurity, space. These are big topics and big areas. But I'd say what is incredibly encouraging, advanced manufacturing. We have a lot going on there. That it is a broad base of different areas, but it's areas that have been identified because there is not enough capital flowing to these areas. And the investments are often long duration in nature or require a lot of upfront investment. And so we acknowledge that just private financing of these is never going to scale unless we're able to change the math equation. And that's the role that we're coming in and seeking to fulfill through our program. And then the Office of Strategic Capital is coming in to provide program-related, value add and assistance. So they have reached back to PhDs in the department that know these technologies, understand the need, are able to get a sense of what's happening with procurement. And they're also looking at, are there opportunities to provide the appropriate security clearances so that way there's an understanding on the high side of what's happening. And we can work with very trusted investors in that context.
Well, let's open this up to the audience. Questions, please.
Thank you so much for being here.
Yeah.
I'm curious how your office, with the discretionary funding and authorities it has helped to support the Biden administration's goals in boosting minority-owned small businesses, and also the administration's industrial policy more broadly.
Yeah. So I'll share with you, the philosophy, right? When I think about undercapitalized and underserved, there's so many similarities, and I'm a believer in rather than over-regulating and trying to carve out separate programs, how do you create more flexibility and regulation and policy so it's attractive for capital to flow in certain areas? And so when we introduced this new instrument, we also brought forward a number of regulatory reforms, so that way there was more flexibility in terms of meeting the needs of different types of financing, understanding that different types of management teams run different types of funds based on the areas that they're investing or where they are in the country or what the investment strategy is. And so the idea was to broaden it out. And then also we had a statutory basis to say that we could give priority to providing funding to any private funds that had a focus on underserved or undercapitalized. And we left that very intentionally broad. And it was more be able to show the demand signals to the market, provide education to different communities about it, and see if we could work with the market to try to stand up more funds that are addressing different needs. So earlier today, I was talking with an incredible, very accomplished Latino investor who wants to put together a $1 billion fund that's focused on Latino entrepreneurs. We have an amazing fund of funds that has applied for the program right now that's going to focus specifically on seeding. This could be a fund of funds, so Black GPs that are then going to invest in Black-owned and led businesses. And so it's these ideas of saying, there's lots of different needs, and rather than us tell you what they are, because the need is different in Kansas than it is in Brooklyn, than it is in Washington or Oregon or Miami. Instead, tell us in the narrative, in the application, what is the underserved need that you're filling, so we can prioritize that application, and then we can address it. So I hope that helps.
Other questions?
Yeah, my name is Terry. Thanks for being here today. Actually, just won phase 1 ANSF SBIR.
Congratulations!
Program, great way.
That's great.
How should we think about SBA funding as we scale? Right, so we're like, we're thinking about raising our seed round in the next 6 to 12 months. Then A, B. So how does it correlate with those stages, or should we be thinking about it by the products offered by the SBA?
Yeah, it's different. I think there's no silver bullet, right? And everybody's situation is different depending on, how capital intensive the business is, the growth rate, where you are in terms of, product development. One thing I'd offer up, right, is that there's the SBA loan programs, 7A, our working capital loan program, and 504, which is more the asset-based lending program, where we're able to provide very low-cost loans. Now, the problem with that, right, is that if you are not cash flowing, it's hard to get a loan. But I just bring them up because they are things to think about if you're in a position to, and feel it is the right move to potentially not take on too much outside equity investment if that's the right thing for your business, right? So because you're always making a decision, does it make more sense to finance with equity versus debt at a certain point in time? So that would be working more directly with us through our SBA lenders. With the funds, what we do is we publish a directory of all the SBIC funds we work with. Believe it or not, until about a year and a half ago, we didn't say what investment strategy they have. Now they do, so you can see the ones that are seed stage investors there. I would say a very lovely thing is that all of these funds that are our partners, we thank them for their service as well. And we say, we're providing you with this money that enhances your return profile. We just ask that you take all the calls from, the entrepreneurs that need financing. So they're out there. We're publishing more on there in like the next week or so. So we do it every quarter. But that's one thing I'd think about. And then our network of growth accelerators too, and regional innovation clusters, I'd recommend them as just tremendous resources as well.
I'll add on there, Bailey, you talked about how these tools at different stages can affect the capital stack. And so perhaps SBIR can affect the income statement, and you also have lending tools that can affect the balance sheet in different ways.
Yeah.
Let's take some other questions. We have time for at least a couple more. Here and then there.
Hello. First off, I think it's a really important issue you guys are solving. I know especially after all the money printing in 2020, that a lot of the money was flowing to more well-established companies than smaller firms. It sounds like you talked about that there's a multiplier effect, that once you guys enter the market, then other private funding. And I was just curious, I'm not sure because there's so many complex factors, but is there some key determinant where you've seen the greatest multiplier in certain areas? Is there some metric that you've seen that's been interesting?
So there's been, research on SBIR, I would say, around, that for every dollar that has gone into SBIR from DoD, that, there's another, I think it was $20 that have gone in from the private sector in each of those companies. But it is a large multiplier effect there, and I can get you some more statistics on that. But what I would say, if I think about the SBIC program, and I'm going to go there because I really believe that model of how the government can incentivize creating more diversified baskets of investments in companies, because, it's no risk to the taxpayer. It costs the taxpayer nothing, right? Like there's no appropriation of funding for this program because it's a loan program. And when you've got a diversified basket and you've got the loan on it, you can diversify away a lot of the risk. So it literally costs nothing. So it's not contributing to our federal deficit. It's really important, right? That what we've seen in the past is that for every $1 we put in, there's a 2-to-1 match historically in the program of private LP capital. And a lot of that has come from banks historically because of other incentives with Community Reinvestment Act credit, and then the capital treatment of SBICs is what they call public welfare investments. As we look at where we're going with our equity-oriented instrument and also what we're doing in partnership with DoD, I am already seeing a great deal of interest in more money going into these funds, even though we might not be able to lever them as much. But the other really cool thing I'm seeing is that a lot of these funds then are talking about how they're going to set up SPVs to invest more in these companies, or they're going to have parallel vehicles. So one of the things I've been thinking a lot about is how we're going to capture all the other capital that comes in around these businesses at the time of initial investment, but then also as they're growing and scaling as a result. So.
And over here.
Thank you. I was curious to understand, how do you build a team that is best suited to evaluate the viability of companies? I mean, in the case of defense, the government's the customer, consumer of products, so there's this sense of a direction there.
Yeah.
But for many emerging tech, and if government's the evaluator, how do you build the winning team?
So the question is, how do you build the team that can evaluate all the inbound interest that you have?
Yeah. So two very different things on SBIC and then SBIR, STTR. For SBIC, our team in many ways I'd think about as being like an institutional investment consultant, so a team that does due diligence on private funds and monitors them. So it's maybe like a Cambridge or a Mercer or some of these other big institutional investment consultants, or like a large foundation or a pension. We're retooling the team because the team used to do a lot in private credit, and now we're saying, okay, now you have to learn how to underwrite venture funds and growth equity funds. And so, that's the skill set that we're looking for there. What I really think is valuable about our partnership with DoD, we often call it an OCIO model, is that we understand DoD's strategic objectives and the technology areas that they're looking for. And then they also have talent that understands some of the risks in these technology areas and the size of the market, so that way we can layer that on as we're thinking about the investment strategy and how we underwrite those portfolios. On the SBIR and STTR side, there are reviewers for those applications that each of the agencies and departments that we work with have, where those are experts that understand those particular technologies, because you need to have deep expertise depending on the area that's being evaluated. And so we manage and administer that program, set policy for it, but having the talent and expertise within those agencies and departments is vital.
Bailey, I've got to say, from my own experience in government and in partnering with you on these tools, you truly stand out as a transformational leader in this area. And we are lucky that you chose to serve and to bring your talents and deep expertise to solve really big problems for our country. Do you, as a final thought for this class, do you have any comments for this group of incredibly talented students about how they could make a difference?
Again, I go back to, I think if there's opportunities to serve, it's a wonderful thing to do. I know it can be really hard to do. It can be hard on your families, and you make choices, but I find it incredibly rewarding when you're able to take the different experiences that you've had in your life and be able to give back in that way. I would also say it's so important always to listen and understand the nuance. There's a lot of political headlines out there. We have incredible civil servants in this country that are very, very mission focused. And I'd say for everyone, the more we can focus on the mission at hand and not the politics, the more we can get done. The more we look for what we have in common, we can start to move the needle forward. So.
Bailey, thank you for serving and for doing so much, and thank you for coming to class with us this week.
Well, thank you for everything that you did working with us to stand up OSC. I mean, it was incredible work. We had an amazing team, and we could not have done it without you, Eric. So
such a privilege to do it, and truly echoing for all in this class, if you have a chance to serve, as Bailey said, go for it. And you don't know at what stage that'll be, but it's important to do. Again, Bailey, thank you for being here with us.
Thank you.
And so this wraps up class for this week. Thank you all.